attending our webinar here this morning on the West Coast. I hope everybody is off to a productive start to the new year, filled with productive activities and learning, skill building, and focusing in on achieving your goals here in 2018. My name is Chris Kargakos. I run retail sales for Retirement Funding Solutions, the nation's leading HECM for purchase lender, largest distributed retail lender, specifically in the housing, wealth, mitigation, risk mitigation, and space. So today we're excited to bring Jamie Hopkins on here. Jamie is a dear friend of the firm and really focused in on a lot of great things specific to helping our retirees achieve a more sustainable retirement. One of the things that Jamie has taken great lengths to really kind of dig into and understand is really what this tax bill means and what tax bill reform will mean for the broader population specifically, as well as for individuals and their businesses. And so we've asked Jamie to come on here today to really demystify what this is and explain how that will impact all of us. As you know, Jamie is, or you may not know, but Jamie is the Associate Professor of Taxation and Co-Director at New York Life Center for Retirement Income. He is, again, a friend of the firm, and we're really excited to have him on to share kind of what he's been able to uncover and walk us through this bill. So Jamie, with that being said, thank you for joining us, and what can you tell us about where we're going and what we can expect here in 2018 with this tax reform?
Yeah, thank you, Chris. Thanks for having us on that and bringing me on. And yeah, this will be fun. So, I'm sure a lot of people have read a lot of news articles, or at least read the headlines of news articles about the tax bill. I know that's actually a more popular way to do things today. So, one of the things, this will be pretty fast-paced. Honestly, if this is your first webinar or kind of live event on the tax reform, I've got about 62 slides in here, kind of about changes in tax reform. And honestly, it could be 3-4 times this size right now to kind of cover everything that's changed. So a lot of big changes. Some stuff I'm going to spend, kind of a brief amount of time on. Some I'm going to spend more on. And even as Chris just said, kind of how do we get here, or where are we going? That's actually, I'm going to hop over here. Kind of one of the first things I'm going to talk about is that, we're kind of through our introduction for the most part. I wanted to make 2 comments here, kind of an introduction stuff. I'll actually hop back one thing. One of the things I do at the American College, so I plug it, is I run the Retirement Income Certified Professional Designation Program. It's a 3-course all focused on retirement income. Most of you probably heard about it at some point, but I always drop that in there. And then if at some point you really decided you like listening to me today, or maybe you hated listening to me, but you thought it was useful information, I'm available for speaking, and I have my email on there, but that's all the plug stuff I need to do on my side. So what am I going to cover today? Like I said, it's going to be kind of like drinking from a fire hose here. We're going to cover a lot of stuff. I have put some stuff in here, a little bit more information kind of about housing, wealth impact, the mortgage interest deduction, a couple examples, because I know a lot of people on this call are going to be interested in that specific topic. So we're going to get to that here in a little bit. So I'll first start off kind of individual income tax reform. What happened there? What happened to us as individuals? We'll talk then about the estate tax reform. Now, for financial planners, financial advisors with high net worth clients, insurance agents, that's going to have an impact. For attorneys, it's going to have an impact. We're going to look at a couple of the different major things that changed there. But that's always been an area that's kind of tough, because the importance of planning doesn't go away with tax reform. We'll talk about a little bit on corporate and business tax reform, mostly focusing on this, what we're going to call Section 199 Cap A. So you're going to hear that a lot. What that just, we say that Cap A because it's the code section, but you're going to hear that a lot, the 199 Cap A pass-through deduction, which is basically a potential 20% deduction for pass-through businesses. That's probably the most complex change that occurred. It's pretty much brand new, and it has a lot of different moving pieces as part of it. So I'm going to cover a little bit of that. As I said, that's going to be new. You haven't seen that before. It didn't exist. So you can spend 2 hours on that. I've spent 2 hours with some attorneys learning about that already this year. So that's a pretty heavy burden right there, that Cap A deduction. We'll talk about kind of some of the impact on retirement planning. Again, retirement planning, as I think, kind of made it out without significant changes. So we got a couple things in there that moved. We'll talk about the impact on kind of housing. The mortgage interest deduction is mostly what I'm focusing on here. A bit on impact on reverse mortgages to kind of let you understand what's happening with those mortgages out there, what's happening with lines of credit, reverse mortgages, how is that going to react, and then a little bit on kind of the general impact on financial services. So the very first part is kind of, how do we get here, where are we going? So this is just kind of the road to tax reform. And I'm not starting too far back. I'm basically going to say, the road, or the runway here, for thinking about a runway, was pretty short to tax reform. Kind of the first draft of a bill we really got was November, and this was signed into law December 22nd. That's not really typical of a law of this magnitude, this size. Typically, we have months and months of kind of back and forth, things being leaked, and people can do a little bit more planning. This was pretty fast, so a lot of people are still struggling to catch up, figure out what's in the bill. I've read, probably 100 different things out there on the bill, and I can say probably all of them have a mistake in there. That being said, my slides, I'm sure, have a couple mistakes in them at this point. Michael Kitsy's, had some mistakes on his online, so if you're reading that, not all those things are correct either. And so what's the point of that? It's not to say anyone's right or wrong at this point. It's to say there's still a lot of misinformation out there because there were changes from the two House and Senate bills. Those went pretty quickly through committee, signed into law, and people are still catching up on what was actually put into law in kind of the final bill. So we'll look at that as best we can here. For the most part, this bill's effective now. It really started January 1, 2018. It's here. So it didn't give us a lot of run time at the end of the year either. We pretty much signed into law 22nd, and there it was, effective January 1st. There are some things that actually kicked in earlier. We see the mortgage changes actually started December 15th, 2017. In some ways, there was kind of a little bit of wiggle room. We'll look at that. Some things still don't start for a while. Alimony changes I will cover in here. That's actually a big change. It's a big revenue item, impacts a lot of people. That doesn't kick into 2019. We've got some things that are phased in, short periods of time. So most of the corporate and international tax changes are permanent in the sense, I kind of have the single quotes around the permanent. As permanent as anything is in the law, right? Obviously, in 2 years, 6 years, 8 years, those could change, 20 years. But in the sense that they don't automatically disappear, they're permanent. Now, most of the individual tax changes that we will cover are temporary, meaning that really starting 2026, we revert back to the rules that we had last year. So a lot of stuff is, kind of a 7-year runway, and then we go backwards again. And there's some reasons for that, kind of why they weren't permanent, and a lot of it is because of revenue issues, that they needed to then have those go off the books and have increased revenue again in 2026 and 2027. Now, could those be extended out? Of course they could, but it'll require some more legislation. I've got here kind of at the bottom, and this is going to be kind of a driver for a lot of things. The kind of budget deficit as part of the Tax Cuts and Jobs Act, even though that's not the official title of the act, it's actually technically not long enough to be the official title. The official title is useless, so we call it the Tax Cuts and Jobs Act. But one of the things they're trying to balance the increased deficit by tax cuts. This bill, plain and simply, is tax cuts. We'll see that in a couple areas. It's cutting taxes. Now, who benefits the most? I'm going to talk about that too. But it is a tax cut bill, and fundamentally, that's what it is. And tax cuts will spur on the economy. I'll see that kind of in a couple slides. But it does decrease government revenue, at least according to most projections. Now, some of that gets debated to some degree, but the government assumes that this is actually going to decrease revenue to the government in the long run by a pretty significant amount. We're talking about $1.5 to kind of $2 trillion over the next 10 years, which is not insignificant. Now, what does that set up? Well, that sets up something that we call pay-go, pay-as-you-go tax cuts, which is essentially a rule that's been around in Congress for a while that says, look, if you're increasing deficits by the laws you pass in a given year, you have to cut back certain programs. Now, Congress does have also a mechanism for waiving this law. They've really never let it impact them. They always waive it. So could the tax bill cause automatic cuts? It could. If the pay-go law is actually kind of forced into effect this year, we could see it could cause a $25 billion cut to Medicare and other social programs this year. It's, again, probably highly unlikely that, Democrats would force a $25 billion cut to Medicare. So we're not kind of expecting that to happen, but it's around, so they need to do something about it by the end of the year. But will we see other changes to programs moving forward? And that's kind of a big question. Does it set up that conversation? So then I would say, who are the winners and losers here, right? Everyone likes to hear that question, right? Who won, who lost? So what are the winners, right? Lawyers, right? Lawyers are going to win here. Plain and simply, they've already won. The amount of lawyer-provided CE webinars and presentations has skyrocketed this month. I know they're way up. And they're in demand, right? Because we had major legal changes. So guess who you need when we change the law? You need people to understand the law. So lawyers are going to win here. CPAs are going to win. There's more tax planning you need to do now. The tax law changed, so now there's planning that's needed. Corporations are going to benefit. This was a significant tax cut and simplification in the corporate side. So corporate, and we're talking about C corporations there primarily as the clearest winners, down to a 21% tax rate, which we'll have on a slide later. Then I say, generally, anyone who is filing standard deduction already, especially single filers, it looks pretty much like a clear tax cut for that group too. So that looks pretty good. I say heirs and heiresses of multi-million-dollar fortunes, big tax benefit there, basically kind of removing 40% tax on millions of dollars for people. So that's a pretty clear winner. And actually the economy is a big winner here. So Tax Foundation, I use some numbers from Tax Foundation. I also use some CBO numbers. I try to use places from different sources so not to feel too stuck to one in case you don't like one organization for whatever reason. But Tax Foundation says, they expect to see a pretty significant increase in the economy over the next decade here. Almost a 0.5% increase in GDP annually, which kind of raises from an expected, kind of around 1.8 to, I think, kind of an annualized return of about 2.13. I think that's about right. I know that those numbers, it's not just kind of the 0.44% on top, but that's kind of how it works out. The other thing here, if you look at a lot of the Tax Foundation's examples, they're showing most households are going to see between a 1 and 4% increase in after-tax earnings, with kind of the average around 1.1%. So while that's not kind of kind of groundbreaking, if you're making $1,000 a year, you're getting an extra $1,000 back in taxes, which is not insignificant, right? Each year, that's a significant amount of money. Now that being spread out, though, looks a little bit different, right? So that's kind of the average. What you see there is then actually a lot of people are going to benefit closer to 2%. Kind of the top 5% and over 1%, they're going to benefit a little bit more. But kind of generally speaking, right, somewhere, as you see, kind of around the 2% and maybe a 1.5%. And then you see kind of the third colored line here is actually what happens in 2027. And why kind of the average gets brought back down is because most of the individual tax cuts are temporary, right? So starting in 2026, basically most of the individual tax cuts are gone. So you're going to kind of revert back. You'll actually see some people, if nothing changes by then, which is not always a great assumption, that a lot of people actually lose money kind of in that time period. So changes would have to occur again. And really, that's what this bill sets up. It sets up another bill at some point. So I say potential losers. There's a lot of those out there, too. Married filing jointly couples in high state income tax states, New York, California, New Jersey, Massachusetts, Connecticut, especially if they were itemizing, especially if you're a W-2, if you're a business owner, we see maybe you'll end up better. But those ones, there's definitely some concern in those areas, high itemizing, high state income tax states. On the flip side, though, some of the states that really rely on federal government funding, kind of those I think I have 4 of the 5 up there. Montana is also the 5th one. Alabama, Kentucky, Mississippi, New Mexico, Montana are the 5 states that pull the most money back from the government as a percentage of what they pay in. So what that means is they receive a lot more funding from the federal government than they pay into taxes. They're very reliant. So cuts to social assistance, Medicare, Medicaid programs, land, farming stuff would hit those states the most. Now, that's not a direct impact of the tax bill. They might be okay if government spending doesn't change. So the other one, anyone seeking tax certainty, as I said, the lawyers win because there's a lot of uncertainty out there now, both today and moving to the future, because we have now temporary tax changes, right, that revert back. So how do you plan when something's temporary? A lot of homeowners here clearly lost a deduction, and the mortgage interest deductions will hit that. Charities could really suffer here, but we don't know. We don't have great experience with this. 2010, federal estate tax went away for a year, and charitable bequests dropped a third for a year. So if we follow that as a model, that's 1 year, so not a great model, we could see some pretty significant drops in charitable contributions over the next couple years. Some state and local governments could really be impacted too. Probably not year 1, probably not year 2, 2018, but moving forward, 2019, 2020, we could see some pressure there. You said federal government programs. Some people just in the wrong place at the wrong time. That just means your situation is kind of unlucky. That might be some large families with 2 high income earners. There could be there's kind of phase ranges. If you're kind of maybe over 400,000 with 3 or 4 kids, 2 income earners, it could be something where you're actually paying more taxes than you were before, and you just happen to fall into the wrong little bit of the tax code that doesn't like you a lot. So the other part, kind of the main focus here are these 3, right? Individuals, estates, and businesses. And there are tax cuts for all 3. So let's start then kind of looking at some of the specific things that happen with individual income taxes. And so these are kind of the major changes and some of the major things that didn't change. So the first thing is the effective date 2018. We are now sitting here under a new tax regime today. Now that's not going to hit our taxes really to 2019 when we start filing next year, but as I said, most of the cuts and changes to individual temporary and will revert back in 2026 and December 31st, 2025. We'll see the sales and local income tax deduction at the state level is going to be limited to $10,000 a year. The mortgage interest deduction is going to be reduced down for many people. No more miscellaneous expense deductions here. Charitable contributions remain and actually increased, in a sense, the total amount of cash contributions you could make a year from 50% of your AGI to 60%. That being said, kind of all those things, the SALT, the mortgage, charitable contributions are only valuable if you're itemizing. Otherwise, not really valuable. And we're going to see that not very many people are going to be itemizing. So essentially, for most of the population, those are gone as deductions. You're not going to be able to take advantage of them anymore because what we had is a change in kind of the tax rates. We had an increase in the standard deduction, almost doubling it. And that almost doubling of the standard deduction is going to wipe out the ability for most people to kind of take advantage of itemizing. Now, that's not necessarily a bad thing. What that means is you're probably in a better tax situation in a lot of those situations, but you're not getting to take advantage of charitable contributions, so why put money to charities? Well, you have to be charitably inclined, which most people are if they're donating to charities. Again, mortgage interest loss. Well, again, do you want to own a home? Okay, and there's debate about whether that being limited will impact home ownership. So we'll have to kind of see. There's different models that say different things there. The Affordable Care Act mandate for individual health care, meaning that kind of penalty tax, if you don't have qualified health care coverage, goes away starting in 2019. So 2018, still have to have health insurance or you're penalized. 2019, no. Again, the idea there is that some healthcare bill is going to be passed in 2018, so we'll have to wait and see that. Capital gains, net investment income tax, and the alternative minimum tax basically all remain unchanged. So those pretty much stayed around. Now, quickly, I'm going to show you kind of the individual tax filing, changes to the rates and the new income levels. And what you'll see is what happened is in a couple areas. I actually I don't think I have my draw function up here. Let me see if I can grab this really quick. It's useful here. Let's see. All right, it's not the prettiest color in the world, but I've got it up here. So what you'll see is, right, some of these areas, right, there were cuts to the tax rates in the same ranges. So you got people with $9,000 to $38,000 of income. Basically, that's a tax cut, right? It's lower. You see people in the 25 range, right? Essentially same range. Actually, this one gets condensed, and the next one we actually then take longer, basically, to get to the 35% range in some of these cases, so or kind of get out of that range. So there are some benefits there. Single filers. It seems like the next, let's see if this clicks through. I guess I got to go back to the clicker now. Normal non-drawing mode. So I'm going to have to erase that. But basically, same thing here. What you see is kind of the ranges again for married filing couples. Tax rates got dropped in a couple areas and got extended out. Now, what it looks like to me, some of the analysis I've done is the kind of $400,000 to $600,000 range, married filing jointly. I'm not 100% sure that large families want to be in that. It looks like you might want to stay below the $400,000, and we'll talk about that because there's some child care tax credits that get phased out after the $400,000. But for a lot of people, right, this is tax rates are being reduced and the income tax levels are changing a bit. So they've been modified. So again, the specifics of that kind of depends on your situation. So I'm not going to spend much more time on that. Anyone can look those up. They're all over the place. So they're actually the first page, basically, of the tax bill, too. So they're the easiest thing to find in there if you want to look up the new rate schedules. All right, so the rate schedules changed, the tax rates changed. And so the next thing here is what's really important. Well, the next really important thing is the increase in the standard deduction. And so this is kind of how much, right, the standard deduction you decrease your income by. Now, what this really functionally did is about 30% of all tax filers, individual people tax filers, households, did itemized filing before the bill. Now the projection is with an increased standard deduction and a removal of some of the itemized deductions being available through 2025, that only about 5 to 10% of the population will now itemize. So if it's around 5%, which is what a lot of the projections show, most people will no longer be itemizing, right? We're going to go from 30% down to 5%. So a lot of people are moving out of that. In a way, that is simplification, at least on the government side. IRS has simpler reviews here, simpler tax filing. And what that means for most people is what I've said before. Charitable contributions, mortgage interest, and your state and local taxes are no longer deductible, right? You're not getting a tax benefit for paying them. Again, that doesn't mean you're in a worse situation than you've been in before, right? It doesn't mean that the tax bill harmed you, but it just means those specific items are no longer deductible. Now, for some people, it could mean you're in a worse situation than you were before, depending on how much you were paying into those items. So the next part here, we say kind of the increased standard deduction. Individual went from $6,350 up to $12,000. Married filing jointly, $12,700 to $24,000. And I said basically it's doubling, right? That's kind of what you've heard, is it's been doubled. Both the numbers, the $12,000 and $24,000, are indexed for inflation, meaning those will increase essentially annually through the next 7 years. Now, the extra standard deduction for the elderly or blind, so those age 65 or over, they remain the same. They didn't change. $1,600 for a single individual and $1,300 per spouse that is age 65 and over. And that just gets tacked on top of your other one. So let's say you're married filing jointly, 2 spouses over 65, you get that at $2,600 to the $24,000, so $26,600. So that just tacks on top. We also saw the repeal of all personal exemptions through 2025. Again, we'll revert back to old rules at that. point. So the personal exemptions, basically the children, right, that you would add on there, your exemptions. So kind of here's an example. If you had a bunch of children, you could be in a worse situation now. And here's kind of the example. You had family, mom, dad, and 2 children. So 4 personal exemptions give you about $16,200 under the old rules, plus your standard deduction of $12,700, which will put you at $28,900. And so this is still comparing somebody who was doing a standard deduction, not itemized filing. Compared to now, what would it be? $24,000. So you'd be about $4,900 of a deduction short under the new rule. Actually, even a family with 1 child would push you over in this calculation. Now, you can't stop there because, guess what? Other things changed in the bill. And so this family right here, kind of everything else being equal, is probably still better off under the new tax code. What we'll see is there's now an expanded child tax credit and qualifying dependent credit. Now here they wouldn't be eligible for the, we don't have enough information to say whether they'd get a non-qualified family member dependent credit of $500, but they've got 2 kids. We would say the expanded child tax credit went from $1,000 to $2,000 per child, and $1,400 of which is a refundable credit for those who net out to 0 tax liability. So that benefits some people not paying a whole lot in taxes. But credits are better than deductions, right? A $2,000 increase in a credit offsets taxes by $2,000. So if you actually were, in this case, maybe $4,900 better in a deduction, if you're at a 20% tax rate, it'd be about $1,100 or $1,200 it would have saved you in taxes, as opposed to the $2,000, the higher tax credit for children, plus the higher standard deduction. So this situation, even though it looks worse at first, it's a little bit, and that kind of back to about that $1,000 or 1% that I talked about before. That's a lot of this stuff's falling out to be small benefits, but benefits, right? Now the problem here, as I mentioned this before, those $400,000 for joint filers, once you kind of kick over that threshold, there is a period where maybe this is not better for you unless you start earning a lot more money. But again, probably going to be okay. Not talking about significant impacts there. Again, $400,000 joint filers, maybe you're $1,000 or $2,000 worse in the right situation, but hopefully that's something you can handle. Another piece here, alimony changes, fun, right? This is fun stuff. So current law, and this is still current through 2018, alimony payments are deductible for the payer, so the one making the payments to their ex-spouse, deductible, and included as taxable income for the recipient. So that's big, right? That's kind of the traditional way to do it. Now your divorce decree could come up with some other piece where somebody's paying the taxes or moving the deduction, but generally the one making the payments get a deduction, the one receiving it has taxable income. Well, starting in 2019, that ends. What happens? Alimony payments will no longer be deductible to the payer and then no longer reported as taxable income by the recipient. So what does this say? The person receiving the payments is actually better off under the new law. The one making the payments is worse off. Why did they make this change? Well, very simply, who is usually making alimony payments, right? The spouse that earns more money, right? That's the one making, the one in the higher tax bracket. So that kind of tax arbitrage, the fact that that person was getting a better tax deduction than the person receiving alimony was paying in income. So this is actually a huge government revenue generator, right? So this is actually going to generate billions of dollars over this tax period. So kind of over the next 5 years, 19 through 23, it's almost $2 billion in increased government revenue from changing this. And it actually goes to about $6 billion if you extend it out a 10-year time frame. So this is a big government revenue generator, this change, and that's to kind of allow other tax cuts to occur. Now, what's really fun about this, right? Well, guess what? This makes prior, divorce agreements and alimony payments ripe to be modified. And now I'll tell you who's going to win there. The attorneys are going to win. But this is ripe for modification, because if I was the person who was making the payments in the past, getting a deduction at, maybe 35% tax rate, I was putting that into my calculation that I was making a payment and receiving 35% kind of back as a tax break. Now, essentially, my alimony payment is 35% higher than it used to be, right? That's a little oversimplification, but that's a big deal. And so you're going to have people that are going to want to go back and renegotiate this and drop down the payments, right? And so won't that be fun, right? Renegotiating alimony payments that have been in effect for years. I can't even say how exciting that must feel to people. So another thing here, casualty losses are basically just gone. We'll talk about this. This used to be something that used to be able to deduct, and again, you had to kind of itemize and do some things, but this could be a really good deduction if somebody lost a significant amount, cars, houses. Now, there were a lot of rules to this, so casualty losses, kind of major events, storms, fires, theft, there's a whole bunch of them. But each loss needed to be over $100, couldn't be reimbursed by insurance, and your total amount had to exceed 10% of your adjusted gross income. So I always have the example there. It had $100,000 adjusted gross income. You needed more than $10,000 of casualty losses in that year before anything was deductible. So if you had $11,000 casualty losses, you could then get a $1,000 deduction. But when people were losing houses, cars, things like that, those were pretty significant items that did kick you over that 10% for a lot of people. So that's essentially gone. Unless what? Unless it was declared a national disaster by the president. That being said, a lot of the times when people have casualty losses, it was because of major national disasters. As I said, like Hurricane Sandy, Hurricane Katrina, and Hurricane Harvey more recently. Now, where can you find out if your storm or your event was a national disaster? Well, guess what? FEMA has a website. It's searchable by years. You can go on there and check it. The other thing, this also means you probably need to go back and review your liability and property and casualty insurance with these changes. We're not exactly sure how all that's going to play out and impact people, but it's probably worth conversation with your insurance agent about, do you have the right insurance? Do you have the right amount? Do you have the right types of coverage? So that's a lot of the personal income tax pieces I wanted to cover right there. I know, as I think said, a lot of questions will probably be submitted. We'll try to get to a lot of the questions at the end, and if we can't get to all of them, we'll email a bunch of them out. So the next part here, we're going to hit some of the estate tax reform. And so kind of the biggest thing under estate tax reform, and again, kind of is the federal estate tax, right? That's the big driver at the federal level. And again, a revenue generator, but really not the most important aspect of the federal estate tax, in my opinion. I'm a big fan of the federal estate tax and transfer tax system. It's been around, as when people say, oh, we're going to get taxed on things. Well, it's been around pretty much as long as everyone here has been alive. So over 100 years, we've had this system in place, or a form of the system. It's been changed a lot, but we've essentially had estate taxes for as long as everyone has been alive that's alive in the United States today. So this has always been part of the agreement when you went to work and accumulated money, that this was a tax built into the system. Now, why the reason I like this tax is not because of a wealth redistribution piece, and I'm not sure the country really agrees with that anymore from a fundamental standpoint. That's really what the tax originally functioned as. But it functions as a kind of warning to do planning, to do your estate planning. Very few people were subject to the federal estate tax before this change. It was about 0.2% of all estates. 2 out of every 1,000 estates were subject to any federal estate tax. Didn't impact a lot of people. What I always say there is, remember, 80% of the top 1% of the United States population, this tax didn't even apply to. This is a very small percentage of the U.S. population, but what it does is it drives people to do estate planning, which is very important. It's just kind of a reminder that it's there. And in 2010, when we saw this tax go away for a year, as I said, charitable requests dropped by 1/3. Estate planning business, from a survey of estate planners that year, said it dropped in half, and very few of the people that they lost actually were subject to this estate tax It changes people's behavior. So essentially the transfer tax system remains intact. Not a whole lot of changes here, except for the fact that the personal exemptions, your lifetime exemptions for how much you can transfer before getting taxed, got doubled. As it says here, from $5 million to $10 million, those are index numbers, so the actual numbers in 2018 is about $11.2 million of property wealth you can transfer your lifetime or at death to somebody else without paying any estate taxes at the federal level, so $22.4 million for a couple. That's a lot of money, right? So not a whole lot of people subject to this tax anymore. The annual gift tax is up to annual gift tax exclusion amount is up to $15,000. Now I put that in there, not part of the bill. It did go up $1,000, but that actually occurred prior to the bill, and that's the number for 2018. That's that number you heard, $14,000 for a number of years, but that's gone up. The top tax rate for estate, gift, and generation skipping transfer tax remains at 40%, even though it applies slightly differently across those three. Step-up and basis rules was a big one that was discussed to be removed, still in play. So most of this remained unchanged. Now we have much higher personal exemptions here from the taxes, up at the $22.4 million for a couple. So what does that mean? Well, guess what? This is another one of those temporary bills. So it ends at the end of 2025. So that brings up a lot of gifting, a lot of trust being used over the next 7 years to transfer wealth out from very wealthy individuals down to the next generation and avoid taxes. That being said, there's some kind of cryptic language that made it into the bill, suggesting that the Secretary of the Treasury Department, or end up being the IRS possibility, will need to prescribe regulations with respect to any difference between the basic exclusion, the $22.4 million for couples at the time of the decedent's death, and the basic exclusion amount applicable with respect to gifts made by the decedent. What they're saying there is they left it open that if you make some gifts during the next 7 years and then you die after 2025, could they increase the taxes at death? They could. Now, nobody has any idea what's going to happen here. I'm not going to guess. I'm just saying it's in there. And so they left the door open there for some clawback of taxes. But the standing point is still, we're going to want to take advantage of this higher tax exemption during the next 7 years. That's the standing point today. But estate planning still needs to be reviewed. People need to take advantage of the higher limits, be aware of state inheritance and estate taxes. Not all of those change. Plan for digital assets, I always mention, because actually most estate plans are out of date due to that today, which I actually think is malpracticed by a tremendous amount of people. And I've written that in some pretty high up there places, but it's still moving slowly. We still care about wealth preservation, insurance, liquidity needs, and protecting the family with estate planning. And that's the most important piece, protecting that family with estate planning. So now we got a couple other areas I put into kind of the estate planning piece, which is similar but not exactly estate planning. But kiddie tax changes. So there's kiddie tax rules. Basic rule was child under 19, full-time students under 24 were taxed on their unearned income at their parents' highest tax bracket. Basically, the unearned income got taxed right on top. But that's not earned income, so they can still keep working, earning income, being taxed at their own rate. Basically, over $2,050, you were taxed at the parent's highest marginal tax rate under the old rules. New rules changed this. We don't care about the parent's tax rate anymore. That's done. Instead, we move to the estate and trust tax schedule, which is a condensed tax schedule. Now, I pulled those in here. The numbers did change a little bit in the tax bill. Highest rate now 37%, and that kicks in at over $12,500 of income. So that's not a whole lot of income from that set. So unearned income over $12,500 for minor kids now, kids under 24, that's going to be taxed at the 37% tax rate. That's not a good outcome here. But that means if we have that situation, we got to pay attention to it. Now, that being said, we said it actually takes a lot of interest to get to $12,500. We're talking about $400,000, $500,000 of principal to get up there. Does that happen for people? Are there other high income earning situations that occur in a year? Absolutely. but we got to watch out for that. That being said, somebody with that much unearned income in a year, they were probably in a higher earning family before, which means they were probably close to the highest tax brackets, which means functionally not a whole lot might have changed in those situations. But it is a big change. The rules are very different here on how you figure out the taxes than they were before. Another one here I want to mention is the 529 plans and ABLE accounts, which are a version of 529. So generally speaking, there was a lot of talk about changes to college savings and college planning. Not a whole lot of that made it into the final bill. Okay, so here 529 plans. Only real thing that changed there, major thing, was this ability to now do distributions from the 529 plan to private elementary and secondary schools for expenses for tuition. So it's not all expenses there, expenses for tuition, cap of $10,000 of distributions from the 529 per year per student to those. That includes religious schools too, they're part of that group. Then in addition, ABLE accounts, they were kind of expanded out in a number of ways. I've actually got kind of at the bottom, I'll just read through that. In short, the contribution limit was increased to $15,000 per year, which allows you to actually roll 529 plans over into a ABLE account to fund it as long as it's the same beneficiary. The $15,000 again really wasn't from this bill, but that was an increase. You can now take advantage of the Savers tax credit as part of this, and they also allow beneficiaries of ABLE accounts, if they're working, they have earned income, to put in kind of up to around $12,000 on top of the $15,000. So there's a little bit of extra funding that can occur here with the ABLE account, so that was a nice change. Charitable planning, as I mentioned, the charitable cash contribution ability actually got increased, but because so few people are going to be itemizing, very few people are going to be taking advantage of charitable deductions anymore. When you think about, is this gift to a charity deductible, for the most part, the answer is going to be not really anymore. We're not going to see any tax benefit from that. So what does that mean? It means two to three big things are going to change. One, bunching contributions. This is actually one of the more important things I'll cover today. Is what's going to change is people are going to make large contributions to charities. Maybe my next 3 years of contributions all at once. I actually did a little bit of that tax planning before the end of the year. I made larger contributions that last week of December to some of the charities for this year because I'm not sure if I'll be itemizing this year. So I'll take advantage of that. So you put them all in 1 year, right? So maybe 4 years you want to make to a charity, do it in 1 year, increases that ability to potentially itemize and get a tax benefit. That being said, a vehicle that can do that, donor advised funds. Donor advised funds have already seen a huge jump in interest. I was looking at some of the data. Schwab, Vanguard, Fidelity runs these types of funds. They were showing 30 to 40% increase in activity recently on these funds, so a big spike in interest. That allows you to basically donate money in, right, to a donor advised fund. You put it in there. What happens then is you get the full deduction today, but you get to spread out distributions to charities over a number of years. So we're going to see a big increase in the usage of them moving forward. Qualified charitable distributions, hopefully I'll have time to cover that in the retirement section. Those got more important. They're a big ticket item now. We got to consider, we got to bring in there. But remember, charitable contributions really stems from what? It stems from somebody having charitable intent. So for a lot of people, that's not going to go away, but a lot of the tax benefits of, for just kind of average Americans of giving to charities, that has essentially gone away. Again, not a terrible thing there, but could see some pretty big losses to charities in the next year or two. So we'll see how that plays out. We don't have a good background run for this, so we're not sure. We don't have a lot of experience. I said 2010, if we follow that, could see 30% drops in some forms of giving, but we'll have to wait and see. Okay, so next part here, impact of tax reform, businesses and corporations. So I would say from the corporate and international, I don't usually spend a lot of time on this in these types of webinars. One, I'm not an international tax corporation expert, so I really don't cover that. Again, most of the people I'm speaking to, that's not their wheelhouse either. So the biggest thing here, remember that C corporations have been really unattractive as a business entity for a while because of double taxation. You get taxed when the corporation makes money, and you get taxed when that earnings are distributed out as dividends to owners. So there's been a double tax standard. Now, one of the things there, what happened? Well, this was a very clear tax cut simplification. Corporate tax rates are now just a flat 21%. That's permanent, as I said, in the sense that any law is. That's a big change from, it's almost cutting tax rates in half there for corporations. Big change. We also saw, though, a lot of removal of deductions, exclusions for business expenses, some changes to net operating losses, some clarification about if you move from an S Corp to a C Corp, some depreciation rules changed, some international revenue rules changed, and so we also saw some big changes to the 1031 like-kind exchanges. So a lot of those were removed. We're now down to kind of 1031 exchanges. The only thing that kind of made it that didn't get cut out was real estate, kind of real property, which is always been kind of the case. Last tax reform, I think the real estate and real property, their lawyers and people down in D.C., their lobbying do a little bit better than a lot of other people. So they're kind of still there. Some big changes to fringe benefits. I'm not going to spend any more time on that right now because I know as I say, we're probably going to be tight getting through all this stuff today. Another piece here of the 199 Cap A pass-through deduction. Now, I actually have probably about 7 or 8 slides, maybe even more on this right here. Realistically, I'm not probably going to go through all of that. As I said, that can take about 2 hours to do this fully justice. So we'll give you a general understanding of it, and there's some other good webinars out there. We could, if you're interested in this, this is definitely a topic that we could do again. Now, what is this? This is a brand new deduction for pass-through businesses. And essentially what the goal would be for this, kind of best case outcome, is this 199 Cap A deduction can be a 20% deduction of domestic qualified business income for pass-through entities. That's a big deduction. Why does that matter? Because it essentially takes the top effective tax rate of 37% down to 29.6% for pass-through entities if you're able to kind of mold your business and income in a way that takes advantage of this deduction. So that's a big deal. Right now, again, unfortunately, this is one of the temporary ones. It reverts back to prior rules after 2025. But that's a big deduction, 20% of income. And again, right, moving your top tax rate down significantly as a pass-through entity. Now, that being said, as we say, kind of qualified trade or business is covered. Now, there's one thing here. If you're kind of this specified service business, so what does that mean? That means if you're doing things health, law, accounting, your attorneys, financial service, they have a kind of different tax treatment under this rule, meaning that they phase out of the ability to take advantage of the 20% deduction. So specified service businesses, if they're high earning businesses, aren't going to be able to take advantage of this, except again here, engineering and architecture, they had good lobbyists. They got themselves removed from the bill last minute. So good job to their lobbyists. I give them a round of applause. So let's kind of look at some of the details of this really quickly. Essentially, I want to let's fast forward here. So this is more of kind of my checklist of questions to ask here. So the question is kind of, is this a service business? If yes, we got to check the threshold amount of what you can earn. And as kind of a pass-through entity, single, married, filing jointly, if you earn over those thresholds, you're not going to be able to take advantage of the deduction. Now, if you're not a pass-through service business, well, now you're going to be able to get probably some deduction, but we got to do some fairly complex calculations. So then we do, we look the lesser of 20% of your qualified business income for that trade or business, or this longer greater of 50% of W-2 wages, or the sum of 25% of W-2 plus 2.5% of your unadjusted basis of qualified property. So what is this, kind of what is all this doing? Well, two things it does. For pass-through entities, if you're earning a lot of money, even if you're not a service business, your 20% qualified business interest deduction under 199 Cap A could be greatly limited or actually completely wiped out if you have no W-2 employees in the business, meaning that maybe you're not paying yourself as W-2 or any employees, or you don't really have any property that you own, depreciable real estate. And so those two things could be a really big problem. That it might mean acquiring property, it might mean moving debt around, it might even mean moving the over to W-2 wages, or in some cases setting up a retirement plan and moving funds over to actually reduce your income to qualify and keep yourself under the phase-out ranges. Since the phase-out ranges are so important, I should probably just mention them here. Basically, so joint filers, the phase-out starts at $315. For other taxpayers, for single filers, it's $157,500. And then basically there's a $50,000 range per person to phase out. So kind of over 14 and over 207. A lot of these benefits phase out, or at least the testing changes. Then I actually have a bunch of examples here. We're not going to have time to go through them. I walked through like a person when their partnership passed through, LLCs, partnerships, all pass-through, sole proprietors. So they're all going to be impacted by this. And most of the examples we're talking about kind of real estate business owners, you own rental property apartments. Those are good examples of people who will be significantly impacted by this. But as I said, I've got a bunch of different examples there. We're going to fast forward through those so I can hit a couple more pieces. So yeah, I hit that threshold for the service business back there. But next part here is going to be our kind of retirement planning impact. So again, drinking from a fire hose here, a lot of this stuff, generally speaking, the bill left retirement mostly as an afterthought in the final bill. There was a lot of talk about nothing. So we saw projections of Rothification, cuts to social programs, cuts to retirement savings deduction amounts. None of that materialized. It was never ended up there. So we saw some small changes, some changes to qualified plans, Roth conversions, recharacterizations, and then we saw some increased strategy growth here. So the first piece, there was an extension of your ability to basically pay back loans that you took from a 401k or other qualified plan, and then you were fired. You were terminated from employment. You left service. They used to be due in 60 days. Now you have to kind of your tax return date for that year. So that got extended out a little bit. So a little bit of loan relief if you were fired while you had a loan from your qualified plan. And basically an extension of qualified 2016 disaster distributions. This means you could pull from your qualified plan, IRA, not be subject to 10% penalty tax. Most of this is kind of hindsight that the distribution needed to have started in 2006-17 can actually be extended out for 3 years, so you can still see people doing this kind of into 2019 if they started in 2017. Again, not a big thing. You'd have to check the FEMA website to see if you qualified due to the disaster. The major change here occurred around Roth conversions. One of the big planning areas out there is that we do conversions. We convert traditional IRA, 401k money over into a Roth account. When that occurs, what happens? You pay taxes, move the money over, and there's always this opportunity to do what we say is a recharacterization and send it back to the traditional account, and you get your taxes back. Well, the new law says no more recharacterizing Roth conversions. You can't do it anymore. You can still recharacterize if you did a conversion in 2017. You can recharacterize that, undo the conversion, send it back. Starting 2018 and moving forward, can't do that anymore. That really doesn't have an impact on tax revenue. This was kind of to shut down some what they viewed as abusive tax planning strategies, but it does hurt a lot of regular tax strategies, which was called tax bracket bumping conversions, where you try to convert money up to your tax bracket. Well, you have to do a conversion by December 31st of the year you want the money in there, but you don't know your tax burden yet. So people used to be able to undo some of that if it created an extra tax burden out past the 31st of December. That's now gone. So it makes doing Roth conversions a little bit more difficult. But that being said, we should see more Roth conversions, it's kind of now my new opinion, over the next 5 years with what is essentially technically temporary tax cuts. We should see more people take advantage of that over the next couple years. So kind of pay attention to that. And that pretty much covers that piece. Qualified charitable distributions, this has been around for a while, but this actually kind of gets heightened, the value of this, by removing what I would say would be the ability for most people to make a charitable deductible contribution because they're not going to be itemizing. For those age 70 and a half, they can make a direct payment from their IRA to a charity. Doesn't show up in their adjusted gross income or taxable income at all, which is essentially the exact same thing. It's actually better than making a charitable contribution and then being able to itemize and deduct. So this is a lot more powerful moving forward. And all right, so I want to mention a couple things in this. So I might run a minute or two over, but if people are here, you bear with me. I'm going to cover a couple more things. Big changes to mortgage interest deductions, right? So what happened? I've got the pre-rules and the new rules. The most important thing that you can take away from this is the language, okay? The language. What we see is kind of pre-2018 rules. Home acquisition indebtedness used to have a limit on the interest on the first $1 million of debt principal, and home equity indebtedness had a limit of paying interest to deduct on the first $100,000 of debt principal. Now, home equity indebtedness and home acquisition indebtedness, those are very important. What does that mean? Home acquisition indebtedness is did you have debt, mortgage, line of credit, cash out of some type that you use to purchase, acquire, build, or substantially improve the home. It's all determined on how you use the loan proceeds, right? A lot of people are kind of loose with this language and have been for many years. It's not whether it's a line of credit. It doesn't matter about that. It matters how you use the loan proceeds. Home equity indebtedness is kind of anything else. So you took money out of a line of credit to pay off credit cards, to pay for college expenses, long-term care, health care. That's home equity indebtedness. Plain and simple, home equity indebtedness starting today is no longer deductible. It used to be up to the $100,000. That is gone, period. You cannot deduct interest on home equity indebtedness, period. There's nothing you can do about it. You also cannot refinance and send that home equity indebtedness into a other mortgage mixed with home acquisition and deduct it. It doesn't change the nature of the debt. So refinancing really doesn't change. That can be a good thing for the reverse mortgage world. Essentially, reverse mortgages, if you're paying off a traditional mortgage, it's essentially treated as refinancing that debt. So if the initial mortgage was taken out to purchase, acquire a home, that is acquisition indebtedness, meaning the interest on the reverse mortgage would also qualify as home acquisition indebtedness. Now, if you have a home that's paid off with the reverse mortgage, right, and you take a line of credit, that is home equity indebtedness, and the interest will not be deductible. There is no grandfathering of that, right? That is immediate. You are under those new rules with the home equity indebtedness. There was a little bit of grandfathering for home acquisition indebtedness, basically being that you get to retain for existing mortgages the deduction on interest paid up to the $1 million as long as the mortgage was in place by December 15, 2017, or you had a contract that closed by January 1 and you actually closed by April 1st, 2018. So a little bit of grandfathering for the acquisition. I do have a couple examples here, but we're pretty much out of time. Let me see.
You know, Jamie, we still have, I mean, we've lost nobody since you started to talk. So if you want to go a couple of minutes over, I don't think anybody will mind.
All right. Well, if people need to go, they need to go, right? So let's actually take a look at one of my examples here. My examples are good. I took time to build these, right? So this is a good example. We'll look at two examples here of the mortgages and the reverse mortgage, and then I'll kind of wrap up after that. So here, I've got a homeowner that has $200,000 30-year mortgage that was used to acquire a house. And then, right, at some point, got a second mortgage on the house in a line of credit and drew $50,000 from it to pay some credit card and college expenses, just to make sure that, right, that it's very clear. So we got $250,000 of outstanding debt. Well, moving forward, right, that $200,000 from the 30-year mortgage, the interest on that is still deductible, again, assuming the taxpayer itemizes. Now, the $50,000, whether or not that stays as a line of credit or they refinance all into one loan, that $50,000 is no longer deductible starting in 2018. It's just gone. So even if you, as I said, refinanced here, what would happen and you paid off the line of credit, moved that over to the other one, it would mean that $50,000 of your $250,000 debt was considered non-deductible interest, so only 4/5 of any interest would be deductible moving forward. There's no real way to cure that problem, right? We're kind of stuck with that. Now, here, that old $100,000 limit existed with home equity debt, right? And mostly we were thinking of HELOCs and reverse mortgages and things where we were cashing out from a home for spending needs. Now, right, that $100,000 home equity indebtedness is just gone. But let's look at kind of what would happen with some reverse mortgages here. Well, homeowner had paid off a $500,000 home, right? 62 sets up a reverse mortgage line of credit, draws $150,000 from the line of credit, and from 67 until 97, we say there's an interest rate of 5%. Well, under the old rules, that line of credit draw, right, we get $5,000 of interest per year, right, doing fairly simple over 30 years, could actually add up to be $150,000 of accrued interest, more than the, kind of the debt amount over that time. Well, we could have deducted that even though it exceeded the $100,000 amount, but the interest wasn't capped. It was the interest on the debt amount. And so we could have deducted that $150,000 when they died or when we paid it back. But any interest above that $100,000, so if we took out, I think it says we took out $150,000, right? Well, interest on that one and the $50,000 was never deductible. What happens now? Well, in this situation, none of the interest on this loan would be deductible anymore because it's home equity indebtedness, zero of it. So that extra $150,000, right, that's basically just a loss deduction in this case now. Again, right, we could see legal changes at some point, but right now that's the rule. Now, a couple things about reverse mortgages. I said those, right, where we actually are home equity, how did we use the money? No longer deductible. But if we were flipping a traditional mortgage or using a H for P, HECM for purchase, that interest is probably still deductible, but at the lower limits now of $750,000 of debt principal instead of the $1 million. So the IRS actually has notifications on this, right, that reverse mortgage loans proceeds are not taxable and that the interest deduction is kind of available when you pay it. And they've also said that actually paying off a traditional mortgage with a reverse mortgage is essentially considered a refinance of that for kind of tax purposes. So that's really important. So that means if you had the $200,000 existing mortgage, you paid it off with a reverse mortgage, that's okay, assuming they use that initial $200,000 to acquire the home. You can refinance and continue that deductible acquisition indebtedness moving forward. So that's a very important point. And that all brings me back to that initial point. The language is very important, right? Home acquisition indebtedness versus home equity indebtedness. And that's all driven by how you actually use the loan proceeds. I can't tell you how many articles I have seen and presentations actually over the years that will show you, well, a HELOC is not, is capped at the $100,000. No, it's not. That means nothing yet. We need to know how the proceeds were used. That's what drives this. And so one of the things, Barry Sachs actually has a great paper published in the Journal of Financial Planning, Recovering a Lost Deduction. I think it's Journal of Financial Planning, but that's still very powerful today. I think that's actually maybe even more important to pay attention to because it's a little bit more concentrated. Other thing here, your state and local income taxes. Basically what we're thinking about for many people, your state and local property taxes are now capped at $5,000 per person. That $10,000 is not an index number. So if you live in an area with high property taxes, guess what? You're kind of stuck with them $10,000 per year that you could deduct. That's a real, that's a real issue for certain areas in the country. Again, the New York, New Jersey, California area is a big issue there. The one thing here, kind of over with at this point, but the sense of prepaying them, the IRS did put out a notification at the end of the year about prepaying these. So if you did prepay or know somebody who tried to prepay taxes before the end of the year, it's actually worth making sure you take a look at the IRS notice, seeing if what you did was actually allowed. The technical sense of prepaying you cannot do. You basically actually need the taxes to be assessed the prior year to be deductible in the prior year. So it really just depends who determines that. Your state and local municipality, it determines whether they were assessed and paid in the prior year. So, all right, I think that's going to wrap us up on the thing here. There's some open questions. How does all this impact the housing market? I say nobody really knows. Some people say this will impact home values, home ownership. Some say it won't. There's different models out there and different people kind of getting to that point. So a couple of things I'll just close with, right, is that tax reform kind of gave up on simplification, if you kind of see here. It really looked at tax cuts. That's really what this was driven as. The 199 Cap A deduction creates a lot of planning opportunities. Those, service businesses, other businesses, that's going to, honestly, that's going to cause you to go to an attorney, to go to a CPA to work on it. It's so individualized. And as I said, we could spend 2 hours on that today and barely scratch the surface. But that's a huge thing. That's going to cause us to do more planning as a pass-through entity. We are going to need further clarification on pieces. How quickly Congress and the Treasury Department will get to it, we'll have to wait and see. This is a big tax cut for corporations and should spur on economic growth in the country. So, that's a big thing. Very wealthy individuals, and when I say that, I mean uber wealthy, right? The tax state tax cuts there, a big deal, right? You're saving people millions of dollars in tax cuts there if you were subject to it. But we're not sure about the total impact of this bill. We might never be, to be honest. And remember that the individual cuts remain temporary. So that does set up a future bill almost immediately, right? We've got a 7-year window to kind of revamp that, or a lot of people will see increased taxes again, and not just increase taxes from kind of now, but actually could be in a worse situation than the old rules. And then I close it, right? Tax attorneys, financial planners, CPAs are not going to be out of work for the next couple years. We are going to be busy. There's a lot of opportunity there. So yeah, I think that's pretty good. And Chris, if you want to close here, it looks like we kept most people here too, so I guess nobody wanted to go.
Well, Jamie, I really want to thank you for jumping on today and visiting with us. I know this is a complex issue, and I know you've taken a lot of time to really kind of dissect this and really kind of distill it down to its simplest forms. Guys and gals on the call, just want to let you know that you will receive a replay of this directly after, probably within about an hour to 2 hours after this call, and really want to thank you for jumping on here today. If you do have questions that weren't able to be answered today, please direct them back to the individual that invited you. They will have a direct line in to get those answered from Jamie. Want to minimize his inbox from exploding after this webinar. So guys and gals, thank you again for jumping on. Jamie, thank you. You did a great job really distilling this down, and looking forward to our next webinar here next month. So if you're interested in attending, please reach out to the individual that invited you. We will be doing an expert series throughout the year on a various variety of topics that will impact your business on a daily basis. So thank you, everyone. Have a wonderful day. Bye.
Thank you.